In finance, leverage is a tool that allows you to control a large amount of assets using a relatively small amount of your own money. It acts like a financial amplifier, magnifying both your potential gains and your potential losses. A common example is margin trading, where you borrow money from a brokerage to buy more stocks than your account balance would normally allow. While leverage can increase your buying power, it also introduces significant risks, including the possibility of losing more than your initial investment. Comparing cash accounts to leveraged accounts shows the trade-off between safer, slower growth, and the high-stakes potential of borrowed capital. This chart illustrates how a small deposit can double your exposure, but remember that the debt component remains a liability regardless of performance. Most experienced investors treat leverage with extreme caution, as it is generally considered an advanced strategy not suitable for beginners. Understanding how leverage works is essential for managing risk. Thanks for watching, and remember that investing always involves risk.